the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares moved higher today to track gains seen in Asia. So if we look at the Straits Times Index, it was up 1.55% at 4,390 points at about 11:59 a.m. or 12 p.m. Singapore time, and that's with a value turnover of some 869 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI ended further in the green, up 1.67% at 4,395 points. Now, in terms of value turnover, that's 2.14 billion Sing dollars. Gainers outnumbered losers 398 versus 205. Top advances for today, we've got for you DBS, GMHUSD, and UOB, and top decliners, we've got here F-Point, Aces, and Credit Bureau Asia. Well, in terms of counters to watch, we do have Yangzijiang Financial, because the investment management company said it has entered into an agreement along with two of its strategic investors to lead the restructuring of Chinese lithium battery producer Ningbo Shanshan. Now, elsewhere, international headlines continue to dominate the conversation, from how shares of Samsung Electronics and SK Hynix rose sharply after forging initial agreements to supply chips to OpenAI's Stargate project. And also we'll talk about what job losses in the US private sector mean for markets. Now, lots prepared for you today, and joining me on the line is David Chow, Director at Azure Capital. David, how are you?
Hey, hi, Tian. Hi, everyone. Certainly, we have lots to get into today.
I hope you're grinning looking at how green the markets are today for Singapore and Asia.
But yes, I am.
Okay. But let's start with global news this time around. Sort of gave that away because Asian equities jumped today. Data showing job losses in the U.S. private sector that fanned optimism for more rate cuts overshadowed a partial shutdown of the U.S. government. How would you read into the latest ADP private payroll numbers and global market reaction, given that the non-farm payrolls numbers will not be released tomorrow?
Sure. I mean, looking at the ADP data, at this juncture, I think the private sector, unexpectedly lost around, I think, 32,000 jobs back in September, and fortunately, that's the steepest decline since 2023, and it also comes on the back of a downward revision for August numbers. So, normally market don't read too much into ADP because it doesn't always, line up perfectly with official, non-farm payroll. But this time, I think the context matters. With the U.S. government shutdown and the official jobs report, potentially delay. So investors are giving this set of numbers, more attention than usual. And the market reaction was quick. As always, we have seen the treasury yields fell as traders actually price in the higher probability of more rate cuts. The US dollar also weakened, and the gold again, climbed close to record highs, and breach highs. And in Asia, but in Asia, equity markets actually rally, broadly led by tech names, sectors that tend to benefit most from easier, global liquidity. So what we are really seeing here is the classic, bad news is good news trade. So weaker jobs growth, raises concerns about U.S. economy. But for markets, it means the Federal Reserve has more reasons to deliver more easing. So that's actually supporting the risk appetite in the short term.
I see. And going back to the Singapore stock market as usual, David, I was just looking at the value turnover, over 2 billion Sing dollars. How did the STI fare today? Any surprises if we look at the biggest movers?
2 billion is certainly a very high turnover. And, for in our definition, anything, from 1.5 to about 2 is considered actually moderate. But when you hit 2, which is the magical mark for us, I think we can actually say the turnover is quite high today. So, with the Asian markets mostly on the rise today, STI actually stood up as, one of the better performers with, 1.7% rise, which again saw it break into a new all-time high today. And currently, I think valuation is trading at a forward PE of just 14 times and forward dividend yield of about 5%. So this puts the STI in a very, very good sweet spot, versus, other markets in the region. And for surprises, not that I could see, but the SG small caps are, obviously getting more attention from the investors. I mean, even more from the investors at this juncture.
I see. Now, zooming in on some of the counters to watch, earlier we talked about Yangzijiang Financial because the firm said it has entered into an agreement along with two of its strategic investors to lead this restructuring of Chinese lithium battery producer Ningbo Shanshan. How significant is this piece of news for company as far as the share price movements are concerned?
I think the deals involve, acquiring an effective stake of, I think, more than 23%. So with Yangzijiang itself, committing over, 1 billion renminbi. And that's, I think, roughly about 4 to 5% of its net assets. So for Yangzijiang Financial Holding, which is known mainly now, as an investment management company, this actually marks a shift, I think, into a more strategic role in, one of China's most dynamic industry, which is in the area of new energy and batteries. And for that, I think some investors will reward firms that secure exposure to long-term growth sectors. So the market could potentially view this as a re-rating opportunity. But while there are opportunities, there are, on the flip side, there are also risks involved. We can see that the company Shanshan is in need of restructuring, and success will depend quite heavily on execution. Any setbacks in areas like governance, profitability, or industry headwinds could actually weigh on returns. So in the near term, I think the news itself is likely to spark more trading interest and potentially volatility in Yangzijiang's share price as investors will weigh the growth potential against the restructuring risk.
And another counter that we want to look at for today, David, is Cord Life, which is a cord blood bank. It said yesterday that it is assessing risks and also uncertainties that could impact its ability to continue as a going concern as it faces a potential one-year suspension. Now, the Ministry of Health issued the suspension on Monday because an audit found that Cord Life failed to comply with regulatory requirements. What should investors take note of on this front?
I guess right now, Cord Life is certainly a key counter to watch after the Ministry of Health issued the notice of intent to suspend its cord blood banking license for a year. So I would say it never rains but pours. So, what we are seeing here is not just one problem, but it includes problems with testing and processing of new units as well as storage tanks that fail to meet viability standards. So I guess to be fair, in response, I think Cord Life has said it's now assessing all the risks and uncertainties that could actually affect its ability to continue as a going concern, and that's a very serious warning to us because if the suspension takes effect, I guess the company will not be able to accept new cord blood units for at least a year, and if you are an investor, you'll be wondering what happened to its revenue then. So survival will actually hinge on its existing cash position and whether it can raise new fundings. So as an investor, I would take note of two things. First, the regulatory risk is real. So if Cord Life cannot satisfy the authorities, then there's a possibility of their license being revoked. So, and secondly, and most importantly, their reputation is at risk, and the reputational damage is quite significant. This is a business, after all, built on trust, and with parents already voicing concerns and exploring legal actions, the credibility of the brand has been, badly shaken. So in the near term, again, we can expect volatility in Cord Life's share price, and I guess the next key milestone is how the company responds to regulators in the coming days, and whether it can present a credible damage control plan. So until then, we're going to see a lot of uncertainty weighing on the share prices.
Now, across the region, David, share prices of these two counters quite positive today. Samsung Electronics and SK Hynix, they rose sharply after Korea's largest companies forged initial agreements to supply chip to OpenAI's Stargate project, reinforcing their lead in advanced AI memory. What do you make of the deal?
Right. Besides share prices of these two memory makers, right, we also have, Micron of the US, gaining as well. So, it's a classic guilty by association. So I guess this isn't just another chip order. It's we are looking at potentially one of the most important infrastructure plays in the global AI race. And when I look at the numbers, I find that the numbers are actually quite staggering.
Is it 900,000? Wafers a month?
900,000 DRAM wafers every month to power, this Stargate's next generation data centers. So the level of demand actually gives Samsung and SK Hynix something they always lack in the notorious, volatile memory industry, which is this move actually provides, longer term visibility and the ability to hopefully lock in a bit of premium margins. So as a result, market again reacted quickly, with Hynix jumping more than I think 10% and Samsung up around 4 to 5%. lifting both share prices to multi-year highs. So I think strategically on that level, I think the partnership actually reinforces Korea's lead in advanced AI memory, particularly in your high bandwidth DRAM, which is again very critical for training and running large AI models. I think for Samsung, the deal also stretches beyond chips. If I remember correctly, it includes cooperation on new data centers, cloud services, and even some floating infrastructure. So giving it more touch points across the AI value chain. So, but having said that, again, investors should know a few caveats. These are only letter of intent, not binding contracts. So execution will be key to this. So scaling to those wafer volumes will again demand huge capex and flawless use. So any downturn of the memory cycle, could still pressure margins, in the near term. And again, there's also a concentration risk. If too much future growth, just on one major customers, any pullbacks on OpenAI's plan could hit earnings of both companies hard.
And if you're just tuning in, when I'm in conversation with David Chow, Director of Azure Capital. Now, earlier you talked about association, and if we look at the markets today, Seoul and Taipei led this rally in Asia thanks to that deal between OpenAI, Samsung and SK Hynix. Taipei's TAIEX index jumped almost 2%. TSMC piled on 3%. But the question is, as we've been talking about for quite some time now, is for how long can the optimism surrounding the global AI and global semicon sector, for that matter, persist given elevated valuations and also concerns surrounding the broader U.S. economy?
Yes, for now, at least on the AI aspect alone, training large language models will require enormous computing power, and that in turn, translate into insatiable demand for high-end semiconductors. So that's why, we could see that TSMC's leading-edge foundry capacity actually benefits from it, as well as the memory it requires, and hence, there are Samsung and SK Hynix also benefits from it. So for investors, I think that this long-term sort of circular tailwind, it's hard to ignore for now, and that's one of the reasons why this stock continue to attract inflows despite trading at stretch multiples. Again, important caveat, valuations are really elevated, as you have put it. I think in some cases, I think investors have priced in forward years of growth about 3 to 4 years. That means the margin for error is more. Any earnings miss, production delay, or supply bottleneck could trigger sharp pullbacks. And secondly, I think the semicon industry has always been cyclical. So AI demand may smooth some of the volatility, but again, if the broader U.S. economy returns, or we are seeing signs of corporate IT spending actually slow down, I think even the strongest player could feel the impact. So I guess the current optimism around AI and semicons can persist as long as companies keep delivering on growth, and as long as macro conditions don't deteriorate sharply. So in the near term, I think the momentum is still positive as investors still want exposure to the AI team. And I guess, but over the medium term, investors will need to balance that growth narrative against the risk of higher valuation and rising capex.
And finally, before I let you go, David, let's talk about this one. Apple has reportedly hit the pause button on a planned overhaul to its Vision Pro headset to redirect resources towards a more urgent effort, which is developing smart glasses that can rival products from Meta. What do you make of the news, and really, how far can smart glasses be the next frontier of growth and competition for mega tech firms, given how long Meta has sort of struggled with this I can't remember what's the name for that device, but also with wearables in general.
Right. I think I remember tackling the Vision Pro question posed to me, I think, months ago.
Yeah.
I think I remember saying that it was launched earlier this year. I think it was over $3,000. I was actually quite impressed on the technology back then. And I also said that I think this new product will face adoption challenge, as I noted that there was this bulky hardware, high prices and limited mainstream use.
Yeah.
So I think Apple seems to recognize that, maybe a sleeker, lighter glasses, form factor may ultimately have more, mass market potential. I guess if we take a step back, I think the idea is that, smart glasses could become the next interface for everyday computing, bring notification or translation or even navigation, to you. So that's a powerful vision, and, that's one reason, certain aspects of the markets are paying attention, but again, the challenges are significant. mentioned, Meta itself has spent years pushing wearables, I think from their VR headsets to its Ray-Ban smart glasses, and again, they have struggled with adoption. So the technical, will revolve around battery life, the weight of the glasses, the heat generator, and, how good is the display quality. Are they real? Not to mention, potential privacy concerns with these always-on sensors. So what should investors take from this? I guess for Apple, the move will signal their intent. They don't want to give the next frontier of consumer tech to their rivals. And if anything, they have the design ecosystem and brand pool to, actually make the smart glasses more appealing. But that's Apple. Anyway, if again take a step back, it's still a long-term bet. In the near term, I think smart glasses are more likely to find their niche and enterprise use cases rather than mass adoption. But over the longer term horizon, though, I think if companies can solve certain engineering and usability issues, smart glasses could potentially be disruptive, perhaps as disruptive as once the smartphone was. So I guess that's why the race is actually heating up at the moment.
I see. Thanks so much for the insights today, David. That was David Chow, Director at Azure Capital. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.